Welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. The World Bank has warned that the global economy will come perilously close to a recession this year, led by weaker growth in all of the world's top economies, such as the US, Europe, as well as China. And here at home, it's very unlikely that Canada will escape an economic hit. In fact, some are suggesting a recession is already here. How bad will it be, and what can you do to prepare for it? Joining me now with his thoughts is Sebastien Mc Mahon, Chief Strategist at IA Financial Group. Sebastien, great to have you on, and Happy New Year.
Happy New Year to you too.
So the R word, recession, it's dominating most headlines these days. What are your thoughts? Are we in one in Canada? Are we going to face one?
I don't think we're in one yet when we look at the economic indicators, but I think it's unlikely that we will avoid one in 2023. We have the odds at about 70 to 80%, so 3 out of 4. So that's for Canada, that's for the US, that's also for the world. And just as you mentioned, the World Bank came out with their forecast for 2023. And remember that the global economy rarely contracts. It happened in 2008, but economists tend to have, an agreement that the threshold for a recession is growth, global growth below 2.5%, and the World Bank is forecasting 1.7% in 2023. So de facto, the base case for the World Bank is that a recession is upon us in 2023 for the world economy.
Typically when you have a recession, it means job losses. And yet our job market is pretty resilient, Sebastien. In fact, we surprised to the upside with job growth in December. Could that change?
That could change, but we do think that the base case is that we'll have a recession, as I said, but a shallow one, maybe one where it's a job full recession, or let's say that the bar is very high for businesses to go with massive layoffs. So of course, we should expect the unemployment rates to go up slightly in 2023 if we do go into the recession scenario, but maybe it's going to be a recession that's not going to be, remembered through history as a painful one. Maybe it's just, a period where growth was elusive, and on multiple fronts, wherever you look at the economic indicators, that's what you see: elusive growths, not signs that the economy is crumbling here.
So let's talk about some of the other key economic indicators and just the impact that inflation is having, like business investment and also retail sales, right? Because we know the spending power for consumers has deteriorated pretty much across the board, but certainly a lot of people feel it more than others. What is it telling you? And I know we do have a chart on weekly average earnings.
Yeah, sure. So the spending power has been eroded quite a bit. And here what we see on screen is the real average weekly earnings in Canada. The same chart could have been produced in the US, just shows that inflation is growing at a faster pace than wages. So people are getting less and less rich as we move forward. So there's a loss of spending power. And when rates are rising quickly, that means that home prices fall. So there's a negative wealth effect there. So that's a huge part of the recession call for 2023. Households being willing and able to spend less. So that's for the consumer. As you mentioned, businesses also, their CapEx plans, their intentions to invest are falling. Interest rates are rising. So the access to capital is more expensive. So you have all of these factors working together to paint a picture. Well, the way we will frame it is we're asking the question, where will growth come from in 2023? And it's very hard to pinpoint something that could produce strong growth.
Now, we only have a minute till commercial break. Does this mean, Sebastien, that there's a growing risk for policy mistake? Because Tiff Macklin, he's very laser focused on controlling inflation. There's obviously a knock-on effect with business investment and retail sales that last a bit longer. So should they be approaching this differently now?
Well, it depends how you define policy mistake. I think the mistake would be to pivot too soon, to start cutting rates too soon, and maybe have another bout of inflation like we had in the late 1970s. So maybe what will seem like a mistake for some if the economy deteriorates further in 2023, in the long run will have been the right thing. So let's say the advice to the Bank of Canada and to the Fed is, when you fight inflation, you need to fight it to the end. That's what history tells us. So if we need to sacrifice some growth in the short run, I think in the end, we will win.
Okay, we'll take a quick break and we'll continue this conversation. Stay with us. Welcome back. Sebastien, I want to talk about housing in Canada because most of our wealth is tied to it. In fact, a lot of our GDP growth is exposed to it. And people are vulnerable because of higher rates, but also because of our mortgage and amortization rules that are different than the US. What's the housing picture telling you, and how big of a risk of a downturn, if you're expecting downturn, could that have on our economy?
Well, I don't think that there's a housing bubble in Canada. We did our studies here. We dug deep, and we think there is some froth. There is a context for adjustments of the prices lower. We can even go to -20, -30% from the recent highs. This is something that we've considered and that has significant probability, but still that would not be a bubble bursting, because a bubble bursting, we've seen what it was in the US in the 2000s. It's not the same thing. Demography is behind a lot of the move upwards for the price of houses, and is in Canada. It also gives us a strong foundation. But of course, rock bottom rates push prices higher, and as we normalize monetary policy, we need to expect prices to fall. And it's a good thing to have an adjustment and not have a bubble that continues to go larger, as we've seen in the US in the 2000s. So as you mentioned, it's about the wealth effect. Households will feel less willing, less confident to continue spending, and recession is nothing else than people keeping their money in their pockets. So we could have that as a very strong factor explaining why 2023 could be a year where very low GDP growth, or maybe negative GDP growth through the year.
Okay. Can you talk about the tone and focus of the Fed versus the Bank of Canada? How different are they, Sebastien? And also, can Tiff Macklem actually march to his own beat, or does he have to follow along with what Jerome Powell is doing just because of the proximity, to us being next to the biggest capital market in the world?
Well, I think Mr. Macklem will have the luxury to march to his own beat at some point in 2023, maybe in the second half of the year, when the tightening is done and central bankers tend to agree pretty much H1 2023 that it's enough with the hikes. Now it's time to keep rates elevated for a while, and the a while part will be different for Canada and the US. Few things: if Canada's economy is more resilient with its labor market than the US economy, this is what we're thinking. Even though housing could be an issue, and the labor market here is very strong, very resilient. The demographic impact that we have in Canada makes for a stronger economy. So we think maybe at some point the Bank of Canada will be able to start cutting earlier, and also with inflation forecasts for Canada being a bit easier than in the US, maybe we have some options in 2023 at the Bank of Canada that they don't have in the US at the Fed.
Okay, yeah, and we're showing this terminal rates chart. What is that showing us, if we can bring that back up?
Sure. So it's telling us that the market is expecting the Bank of Canada to be done with hiking at about 4.5 to 4.75. So here it's between the two. And the US, they'll be done at about 5%. So it means that there's probably one hike coming for the Bank of Canada. We think it's going to be on January 25th, because of the latest labor report that was very, very strong. And the strength of the Canadian economy stronger than the Bank of Canada was expecting. So I think they go in January. For the Fed, there's a few more hikes coming, but the Fed is de facto the world's central bank. And if they're so important for financial markets that likely they need to stay on the sidelines longer to make sure that inflation, is under control before they start pivoting. the Bank of Canada has the luxury to start pivoting before.
Okay. Again, another minute till the next break. I want to switch gears and talk about bonds, Sebastien,
Mhm.
because fixed income has had a brutal year in 2022. It looks like things are turning around. Is that a correct assumption?
Yeah, we would expect 2023 to be positive for sovereign bonds. So this is our call. It's very early in the year, but we're expecting that. We think rates could be range bound through the year. As you know, the economy slows down. Inflation also slows down, but the prospects for growth are getting better because inflation is under control. So all of these things together means that the coupon is interesting. We could have some capital gains if we have a recession, meaning rates get lower and you have, through the year, some bouts of good performance from sovereign bonds. But yes, following a tough year or 2 tough years, 2023 could be, in the green.
Okay. We'll take another quick break. We'll be right back. Welcome back. Sebastien, before the break, we were talking about bonds, in particular sovereign bonds. What about high yield bonds? Is there upside there, especially if risk comes back on the table?
We remain very careful about high yield bonds. All of the metrics that we're looking at about where the spreads should be right now, the fair value of the high yield spreads tell us that spreads are pretty tight and there's room for widening. So if you expect earnings revisions that could be lower in 2023, that means that high yield might be interesting for an entry point at some point through the year. But where we are here in January, I would stay very careful and with an underweight on high yield.
Okay. TSX, what's
Yeah.
your prediction for the market?
We expect the TSX to outperform the S&P 500. Last year, that was our call too. It did outperform to the downside. This year, let's hope it's to the upside, because the valuation of the TSX, and I think this is what we're seeing here,
Yeah.
is very, very cheap on a historical basis. When you look at the history of the TSX, or at least the last 20 years, we have a fourth percentile for the valuation of the TSX based on the forward price earning ratio. So it's very, very cheap on a historical basis. It's also pretty cheap on a relative basis compared to the S&P 500. And its sector composition remains very attractive because as we are in a bear market and we are facing maybe a recession, well, on the other side of that is a new economic cycle. There's a new bull market. So, we're starting to see already some interest about positioning in materials and energy commodities. So the TSX is a good place to be.
Yeah, and I was going to ask, so it is a good time, then, would you say, for those who have been sitting on the sidelines to buy in? And would you expect a broad-based rally, or are there specific industries, maybe say financials or commodities,
Well,
that people could play?
we always advocate being long-term investors. So right now, I think in 3 years, you'll look back and say, well, early 2023 was a pretty good time to jump into the Canadian stock market. Although I can't say until, June, for example. So maybe we'll have some volatility. Maybe we'll be testing the lows. The US, interestingly, Wall Street is in the bear market, but the TSX is not in a bear market. We never crossed the minus 20%. So will it act different? Let's see. But right now, if you want to get a good position on the TSX, I would say just buying the market is interesting, with a tilt towards commodities, energy. If you can take some short-term volatility, maybe, but for potential long-term stronger gains.
Okay. And then the S&P 500, I know we briefly brought up the valuation chart, so it's not as cheap
No.
as Canada. What's going on there?
Well, there's still some optimism. The S&P 500 outperformed pretty much, the world over the last 10 years, at least the 10 years prior to 2020. So, and it's very top heavy. The big names in the world, the Apples, the Googles, there, if you want to buy growth, if you want to buy big tech, big cash flow generators, you go to the US. So there's kind of two markets right now. With rates rising, we see that even the big names are starting to feel the pressure. So there's some pressure at the top, and the average name on the S&P 500 seems to have found a bottom and maybe, be a good place to be. So the S&P 500 as a whole remains expensive on an historical basis, on a relative basis. But if you look at the equal weight index versus the top of the market or the S&P 500 as a whole, we're starting to see some opportunities there. But the bear market is likely not over. At least that's what our historical studies suggest. So again, positioning yourself right now slowly, it's a good time, but going all in, maybe it's a bit early in January 2023.
Okay. Another minute left until our next break. How big a factor is the slowdown in China, Sebastien? Because I have to think US, Europe, big exporters, they have to be particularly vulnerable.
Yeah, of course. And China, the slowdown that we've seen likely is in the past because they're looking at reopening and they're looking to be serious enough at reopening. But interestingly, when they reopen for business, as the world's manufacturer, they find that their clients are facing a recession. So maybe it's not going to be that big of a kicker in 2023 that China reopens because it's out of sync with the rest of the world. But China does look like an interesting investing opportunities now. We see lots of flows going there. The yuan is rising. The high yield index over there is rising. The stock market is rising pretty quickly. So as a momentum player, as an opportunistic play, China is an interesting thing to look at right now.
Okay, more to unpack. We'll be right back. Welcome back. Sebastien, the World Bank in the report, it also noted something really interesting, and that was that with rising rates in developing or developed countries or economies like the US and Europe, what's happening now is that it's attracting investment capital. We know capital goes where it's loved, right? And it's taking it away from poor countries at a time when poor countries actually need crucial domestic investment. So I'm wondering what your thoughts are in terms of emerging markets, what the risks are, what the opportunities are there.
And of course, emerging markets are always risky because of the phenomena that you described there. The flows of capital are very important, and also the investor sentiment can make or break an investment thesis very quickly in emerging markets. So we would focus on commodity exporters for long-term bets. And of course, when you invest in the emerging markets, we always advise that you invest there for the long run because things can be pretty volatile. So places like Brazil, for example, they could be a place where for the commodity exposure, be a good place to be positioned. Mexico could also be a play. And with China reopening or being willing at least to reopen, anything that has ties with the domestic Chinese economy, exporters of goods that are appreciated by the Chinese consumer could also be good places to be. But picking the right timing, it's always difficult. So it's always a long-term play when you go invest there.
Okay. Geopolitical risk, right? This is always the big unknown that can kind of throw our predictions out the window. And we still have geopolitical risk when it comes to Ukraine and the conflict there, but also the tensions between China and the US. What are your thoughts and anything in particular you're watching for?
Well, in 2023, we need to keep our eyes on Ukraine, even if the markets seem to have moved on to another story, because you never know when maybe a nuclear threat comes back online, or new sanctions that mean counter sanctions, and we go into snowball in that direction. So 2023, Ukraine remains in play. Let's hope this conflict ends soon because it's been dragging on for quite a bit, almost a year now. But even if the markets are looking past it, we're still looking at it. China versus the US, it's more about national security, technology, access to markets. So this is going to be a long-term theme. So it's not something that's going to be likely very market mover in 2023, but it does impact sector choices and the prospects for multiple companies there. So I would say these two would be top of the list.
Do you think markets have become more desensitized? to geopolitical risk?
Well, markets tend to maybe make too much of a new geopolitical event and move on to something else pretty quickly. So I think we're in the move on to something else phase right now on both of these themes. Ukraine can anything can happen at any moment. China, I mean, there's going to be bouts and volatility for likely a decade with the U.S. and China story.
Okay, COVID still an overhang?
Still an overhang. We never know when there's going to be, a new variant or something that leads to new restrictions. I mean, China, they're trying to reopen now. Is it going to be a success or no? We're hearing that Chinese are looking to move to just to travel elsewhere to get the vaccines there. So it's still very much an active team. We never know what's going to happen. We never know the impacts. We never know the perception. If a country closes its borders to another one, something that happened recently with China again. So markets have moved on, but we never know when it's going to creep its ugly head back.
Yeah, and you wonder, I always wonder if there's even an appetite anymore, because we know, the economic damage that it has done. Whether there is an appetite to shut things down. But
yeah,
every country is different.
Yeah, and the fact that everyone's calling for a recession in 2023, well, maybe COVID will get rolled into that and not have a significant impact on top of the recession call. So we never know, but it is very much a tail risk. It's not an immediate risk, but it is a tail risk.
Okay. Sebastien, thank you for joining. And for viewers who are watching, and if you'd like to get Sebastien's weekly updates on the economy, we have the website. We'll pull it up there, but you can subscribe to it. It's out every week. Sebastien, again, thanks for joining.
Always a pleasure.
Well, that does it for this show. Thanks for watching. Until next time, stay well, stay wise, and stay well.